So there we go. All right. Happy Friday, everyone. We've got some more people who will be rolling in, but we want to make sure that we get as much time as possible here. So I will share my screen, throw up the journal prompt. Marley, thank you. I'll make a note of that. If anybody can't be on camera today, as always, throw it in the chat. Let me know. I'll just make notes of it for attendance. All right. The journal prompt today is super straightforward. Yeah, it's Friday, so we'll keep it simple. What are you grateful for today? Kind of that super stereotypical journaling question that you've heard a million times and is the quintessential mindfulness question. But what are you grateful for today? I'll take a few minutes. We'll write for 4 minutes. That last minute, if anybody wants to share, as always, you guys know the drill. Coming up on the end of week 10 here. So what are you grateful for today? All right, 3 minutes left. As always, if you finish the prompt, if it was just one of those things where there's like one thing that jumps to mind, takes you 1 minute to write it all out, feel satisfied in what you've gotten down, just take a second, center yourself in the space, take a few big deep breaths, grab some water, a little snack. Want to make sure everybody's rested, hydrated, all the good stuff. Two minutes. About a minute 30. Always nice to take some time and just think about the things that sometimes we take for granted or are just kind of like normal everyday things, luxuries that we get to experience. Maybe not everybody does. What are you grateful for today? About a minute left, guys. $45 seconds left. All right, 15 seconds left. Finish up whatever you're thinking about. Dot the I's, cross the T's, all the administrative work, 3, 2, and we'll call it. All right, awesome. Anybody want to share what they're feeling grateful for today? Anybody? Aaron, do you want to share what you're feeling grateful for today on this lovely Friday out here in Halifax?
Sure. I just wrote down the weather, to be honest, because it's really sunny today, and that just, I don't know, brightens my mood.
Awesome. There we go. I was I was thinking about putting the weather as well. I was thinking I'm grateful for just kind of just my health, feeling good. I'm in a good physical kind of health point in my life. I'm dedicating a lot of time to that, so I feel good in that way. Anybody else want to share they're grateful for today? Beautiful
I can share.
Friday, couple days of rest. Yeah, go for it.
So I do a lot of like gratitude journaling and like my mindfulness journaling. So I like to get very specific with these. So like mine started with the weather, but what I really like is I practice a lot of grounding in like the warmer months, which is just like going outside barefoot and like stepping into the grass for like a few
Yeah,
minutes. So I'm really excited to like have that back into my practice. And I did that this morning and I'm getting like bird food and like going to start feeding birds and stuff again. So like the weather, but more particularly because it's going to let me start like my grounding practice again.
amazing, beautiful. Anybody else? One time for one more.
Sure, yeah. I'm in Winnipeg at the
Awesome.
moment with family, so definitely grateful for that for the family that I have.
It's amazing, Braden. Awesome. Thank you guys. All right. Well, welcome to the last session of week 10. We are coming down to it. It's kind of wild, honestly. I feel like these past 10 weeks have kind of flown by. And one of the things that we focus on throughout this 10 weeks has been kind of really diving into the understanding of venture capital and funding and the different ways that you're able to support your venture financially. And today is just furthering that learning. We've got Nicholas here with us today from Rhino Ventures. And Nicholas, thank you for taking the time being with Labs Batch 10 and looking forward to learning more about you, your background in VC, Rhino Ventures, and everything like that. And yeah, the floor is yours. Welcome to Labs Batch X.
Awesome, thanks. Love this new format, by the way, with the journaling. I think that's super interesting. Cool. So let me jump into it. Can I share my screen here? Yeah.
Should be able to.
All right. Can you see this? Hopefully, it's just the one screen there. All right. Awesome. Cool. So good morning, everyone. And good afternoon to those of you on the East Coast. Excited to be here and congrats on being part of the LOI program. It's a super step forward in your entrepreneurial journey. So as mentioned in the invite today, and as Kyle just mentioned, the goal of today and the reason I'm here is hopefully to give you kind of an introduction to venture financing and what to consider and expect once you get to the point where you might consider raising some sort of external capital. So as I always like to say, as an entrepreneur, your time has now become super valuable. So I appreciate you taking the time to join today, because I know for a fact that you have 100 other things on your to-do list. So definitely appreciate that. Kind of jumping into what's on the agenda for today and why I think there's value in you joining this call specifically. So first, of course, need to plug Rhino Ventures. After that, we'll get into the investment process. I'll give you some insight into what that looks like on Rhino's side. Then hopefully I'll be able to equip with some pieces of advice for preparing for venture pitches and then reaching out to investors as well. And then hopefully we get to spend majority of the time kind of on Q&A. So briefly on Rhino Ventures, who are we and who am I? So I joined Rhino in 2020 in my role as an investor. I work on deal sourcing, due diligence, market research, and supporting portfolio companies post-investment. So to date, I've been working closely with Shobi, Thinkific, Mars, Contact, and Peerboard, which was just exited actually a few weeks ago, which is exciting. And then briefly, who is Rhino? So we're a small and agile team. The partners you see up there, they are all ex-operators and founders themselves. So they were in your shoes at one point, and we like to think that helps us relate to some of the challenges that U.S. entrepreneurs face. Most importantly, I think we kind of view ourselves as service providers. So we're here to service entrepreneurs and support their vision And as such, as kind of cliche as it sounds, we like to view founders as our customers and kind of treat the relationships in that way. More specifically, we're a Canadian focused kind of fund. We invest anywhere from 500,000 to 5 million across Canada. We closed our third fund last year. Oh, sorry, not last year, in 2021, late 2021. So we're investing out of a $120 million vehicle now. Unless there are any questions on Rhino specifically, I'm happy to jump into the kind of investment process and give you some insights on that. Cool, let's do it. So moving on to the more interesting stuff here, I wanted to give you a kind of a look under the hood of how venture funds make decisions. But before doing that, I want to briefly outline who some of the kind of primary capital providers are for early stage businesses that you might come across. You might have heard this already from the LOI team, but when you're ready to raise your first round of capital from outsiders, and that's if you want to raise external capital, of course, there are typically two avenues. So number one, you have angels, and then number two, you have venture funds. So the TLDR is that angels are individuals who are looking to invest independently. They typically write smaller checks and are less involved with companies post-investment. Venture funds, on the other hand, they are entities that source and pool capital together to make investments into promising high growth companies. VCs typically prefer to take a board seat. They'll invest anywhere from 100,000 to many millions of dollars. And as a result, they're also underwriting to significantly higher outcomes, right? When you're at the early stage, where some of you might be right now, kind of at that pre-seed stage, most companies go out and connect with angels to raise the first $50,000 to $100,000 to kind of build the V1 of the product and onboard a few early customers. It's tough for most venture funds to underwrite to companies without some metrics in place. But nevertheless, there are some venture funds that might fit kind of that pre-seed stage. So any questions on the difference between kind of those angels and venture funds?
Nicholas, I actually have a quick question.
Go ahead, Kyle.
It really seems like even just like looking at this this graphic right now, like when people are at those early stages, it almost seems like angels is just kind of like a more attractive option. And yet we've kind of been told that like VC. Yeah, I'm just kind of curious, like whether you recommend that people kind of look for those, like, are angel investors, like, is that considered like family rounds and that kind of stuff?
Yeah, good question. So it is interesting because you are, yeah, definitely kind of bombarded with, oh, you need to go and find VCs, right? Even at the early stages. I would almost kind of, if I was an entrepreneur, I would prefer to actually get angels onboarded in the early stages because number one, the due diligence process with angels is significantly more laid back, to put it in that way. Number two, ideally, when you go out and find angels, you find individuals that have kind of domain expertise in your vertical, and they are able to provide you with super specific kind of input on the kind of early product or whatever it may be. Whereas VCs, they are typically more generalist. They are working closely with 20, 30 companies, right? So they are able to offer less kind of specific insights. So I definitely recommend, if you are that kind of pre-revenue, very early pre-seed stage, going out and connecting with angels initially. However, what I will say, and what I have in the deck kind of later on, is why it makes sense to get in touch with VCs at this point is that VCs invest in lines and not dots. So I'll get to this later, but the best investments that we've made at Rhino have typically been relationships that have been built over 3, 4, even 5 years, right? So we meet the entrepreneur in year 0. We kind of maintain that relationship across months or even years, and then we make the investment. So hopefully that answered your question, Kyle.
Yeah, my very long-worded question, but yes, that was perfect. Thank you.
Perfect, cool. So kind of giving you some more insight into what venture funds look like under the hood. So this is a snippet of our 2022 deal flow review. And this is meant to give you some visibility into kind of the pipeline of a typical venture fund. So I think the takeaway here is that venture funds and investors see quite a lot of companies and only end up with a few investments. So that's just something to bear in mind as you kind of go out to venture funds. It's very much, especially in the early days, kind of a numbers game. Like, it makes a lot of sense to go out and connect with as many venture funds as you can. The kind of approach that venture funds take to the process of kind of meeting a company to actually investing in a company looks something like this. So this is our approach. We like to run 4-week processes with kind of stage gates at the end of each week. So it's typically you have an initial meeting, then you go into kind of light due diligence. Then the investment team at the fund typically reviews the opportunity and kind of the materials. Then depending on where that goes, you would receive a term sheet and then go into kind of more comprehensive DD. In terms of the criteria, so that will differ from fund to fund, but this is, again, to give you some insight into Rhino's process. This is kind of what we look for, these 6 things. So number 1 is, as you've probably already been told, founder market fit. That's almost the most important thing at this stage. So that kind of answers the question of why is this individual uniquely qualified to tackle this specific problem. Number 2 is venture funds typically look for kind of attractive end markets. So we go through the TAM exercises and the SAM exercises and the SOM exercises. So kind of answering the question of, is the current TAM or future TAM attractive? And then number 3, which I think is quite important, is we look for venture scale. So what venture scale means is that an investment has the opportunity to return anywhere from 10 to 100 times the initial investment. It sometimes, though, gets confused with founders thinking that they need to build unicorn businesses, which really isn't the case. So I just want to make that difference clear. We're not unicorn hunting at Rhino. We're looking to partner with companies that have the potential to return a 10x, which isn't always kind of needing to be a unicorn. The last 3 ones here are, of course, on the business model and product. So we look at how scalable is the product and how defensible is their model. Exit potential, we do consider what are the exit opportunities down the road and who are some of the logical buyers for the business. And then lastly, what's really important for Rhino is where can we add value post-investment, because we want to support entrepreneurs as much as we can. And we think we do that best if we kind of understand and have experience in certain verticals. So I'll stop there and take questions, because I know that was quite a mouthful. If there are no questions, happy to carry on. Perfect. All right, so preparing for venture pitches. Again, this is how Rhino evaluates pitches, but I will say that you see this quite commonly across a lot of the early stage funds. So funds will typically look at kind of the 4 M's, as I like to put it. So it's management, market, metrics, and moat. I'll give you kind of a few of the high level questions that we discuss internally for each of these. So management makes sense, I think. So again, why is the management team and the founder uniquely positioned to capitalize on the market opportunity? And this could be either your experience or I think in most of your cases, it could really just be your ability to execute and your ability to learn. Number 2 is the market. So again, a majority of venture funds out there, they are looking for large revenue opportunities in large end markets. They typically look for those kind of $1 billion plus markets. But the questions really that we discuss internally is, of course, how big is this opportunity? Why now? And what tailwinds can you harness to unlock the market opportunity here? The third thing here is the metrics. So what product strategy and go-to-market assumptions have you been able to prove with data? And how can you scale what's working today into a more repeatable machine going forward? Lastly, the moat. So what is your long-term defensible moat and your form of defensibility? Kind of what accumulates in your business that builds this defensibility going forward? So I'll just carry on here, and feel free to stop me if you have any questions on any of this. But I think this is kind of the holy grail of today's chat, and I think this is what a lot of you maybe are thinking about, kind of why and when to raise a pre-seed or a seed round. So I think the first thing, of course, is don't take this as gospel, because a big part of the when and why is your intuition. As a founder, you need to kind of trust your intuition, and you will know when the time is right to raise capital. The thing then becomes translating that why and when into something that investors can understand. So a lot of entrepreneurs, on a separate note, they have this preconceived notion that raising venture capital is a must to be successful, and that's, I would say, almost the furthest thing from the truth. I have met some really amazing graduates from LOI that have raised not a single dollar of external capital and have built a really super strong multi-million-dollar business, right? So that's something else to consider. Another thing to consider, as much as it doesn't necessarily benefit us as venture investors, is sometimes debt is the best route as well. So just having an open mind when it comes to what kind of capital and kind of what you want to build is important, I think. But anyways, say you do want to raise venture funding, you do want to raise a pre-seed or a C round. Why raise money is one of the most important things to consider and communicate to investors. So we typically see investors raise money when you are about to, or you have hit some sort of inflection point and you want to accelerate your vision through either hiring, through sales and marketing, or product development. So the when to the why is when to raise capital is when you have some sort of data, ideally, to support that you've found early indications of either what the market opportunity is, who the customer is, or that you can acquire the customer by doing X, Y, Z, and this can scale. And lastly, that you have data supporting that the customer's needs are met with your product. And then lastly, how much to raise. That depends a lot on your strategy and kind of what type of business you want to build. The more capital you want to raise, the more evidence from kind of that when question you'll need, so more data you'll need. The rule of thumb, though, is usually raise so you have runway for anywhere between 12 to 18 months. So again, feel free to drop questions in the chat, otherwise I'll keep on going here. So this is kind of going back to Kyle's question. This is an important thing to consider as well. And the reason why it makes sense for you to kind of get in touch with venture investors early on is we invest in these lines and not in dots, right? So as mentioned before, I think almost every one of our best portfolio companies and deals have been relationships that have been fostered over a long time. So again, the takeaway is meet your potential investors early on, be proactive, and don't shy away from reaching out to investors, because at the end of the day, their job is to meet high-performing entrepreneurs, and that's why it makes a lot of sense to reach out early on. I will say, once you've met an investor, I think it's important to get constructive feedback, and I think each encounter is really an opportunity to kind of hone your pitch and get feedback on what can be improved for next time around. So that's kind of rip through that bit there, but happy to take any questions if there are any at this time.
I think my question would be addressed in these slides, because that's what I was going to ask about reaching out to investors, but I think you're about to cover that. So
cool, perfect. Yeah, I'll jump into it then. So the first thing is kind of first I'll kind of get into a bit of the materials and what we have seen on our end that works quite well when it comes to actually presenting materials to investors. This is there's a lot on this slide, so I'll just, again, go into the takeaways. When you build your pitch deck, I think kind of the core takeaway here is that people love stories, and that goes for venture capitalists as well. So when our founders are out raising money, we recommend that they build what we call emotional cue-based decks. So emotional cues are essentially answering the question of what do I want the reader to feel and think when they look at this specific slide? So it's a good exercise that we recommend both to our portfolio companies, but also one that we actually use ourselves when we're raising a new fund. So the idea is that we build our deck by going through, before putting any material on the deck, we build out the 10 slides or whatever, and then go deck by deck and say, okay, what do we want the reader to kind of feel and think on each of these slides? And we do that with 2 or 3 emotional cues. So an example of an emotional cue could be, oh, the market is large and rapidly expanding, or the team has an unfair advantage to executing win. So that's just a piece of advice there when it comes to actually building the materials. Actually reaching out to investors. So I think this, of course, is very important, and putting this into context, why it's important is, as you saw earlier, venture funds, they see quite a bit of deal flow, and good investors, especially, they benefit from a lot of inbound deal flow. So the first recommendation here is try to cut through the noise by leveraging your network. So it could be introductions from your peers, from your advisors, from LOI. Try to see where you can kind of get those warm introductions. Just speaking from personal experience, and I'm sure this goes for my colleagues as well, whenever I get a warm introduction, I would always take the call, and the likelihood of that call going further is much, much higher than a kind of a cold inbound. Number 2 is, and I think this is underrated a bit, but I think it's really important to do your homework on which investors and funds you want to be connected with. So consider their past investments, consider their thesis, consider their industry and geographic focus. This sounds, again, cliche, but it's very important that you do as much diligence on your investors as possible, because once you sign that binding term sheet, you are stuck with these folks for 5 to 7 years. So you want to make sure that this is actually someone you want to work with and can add value to your business, right? That is the kind of core takeaway here. Again, when you build the materials, important that you try to fascinate, not generically, but specifically. Your first pitch, make sure, kind of as it says here, that investors know exactly what you're doing in the first 60 seconds, kind of capturing their attention within ideally the first 30 seconds is important. Show why what you're building is awesome. Show them that the market obviously is big enough. Show them that you can, or you have figured out that product market fit. And then most importantly at this stage, show them that this team is 100% worth backing. So that, I think, ends or marks the end of the very quick presentation. And I think there are some questions in the chat here now.
Yeah, there was a few there. I know Paige had a question first here. So Paige, if you want to go through the spiel and ask your question.
Awesome. Thank you, Nicholas. This was so helpful. Very concise, but all really, really good information. So thank you. I am the co-founder of Benny. Julie here on the call is my co-founder. We are launching a wellness-inspired kind of soft energy drink. And I know that Rhino, you guys are mostly investing in tech. So I don't know if this is like the most applicable question, if you're going to have the most to speak to, but I saw that you guys are invested, I believe, Article might be like the one and only CPG. What would you say would be your advice for CPG brands looking to raise money? I know it's kind of like a one-off if you really are going to more tech firms like Rhino, but I don't know if you have any advice on making CPG look very compelling, where sometimes it's not as exciting as tech.
For sure. Yeah, good question. I do think that CPG is exciting, and we actually look at quite a few CPG and kind of e-commerce deals at Rhino. I think, again, what is most important, especially with CPG, because it is a space where kind of your resiliency and grit is very, very important. I think kind of proving that you're the right founder to tackle the market is important, and more so important than maybe in most kind of SaaS businesses. So that's number one. I think number two, I again, if you're raising from venture funds, what they'll need to underwrite to is typically some sort of EBITDA profile going forward, right? unless you sell your product on a recurring basis. So margin structure and being able to show that you can optimize your margin structure going forward is important, because if you think from a venture investor's lens, the way we look at a lot of e-commerce businesses is saying, okay, we think that the market is this big. We think that this business can tackle whatever X% of this market. That means they will end maybe 5 years with, I don't know, X million dollars in sales. And then the big question for us becomes, okay, what does this represent in terms of EBITDA? Because at the end of the day, most CPG brands get sold on an EBITDA basis, right? So where you apply a multiple to the EBITDA. So being able to show that you can optimize that bottom line and build a super profitable business is kind of one of the most important things, I would say, in CPG specifically. So that's the second thing. The last thing when it comes to raising specifically from venture funds, I would say is defensibility. And you probably hear that a lot, but really being able to nail down and communicate why your brand is defensible, and why, you know, if say that one of the big incumbents comes in and decides to roll out a similar product, why will your product stay kind of defensible, and why won't they chip away at your market share? So I think those are the three biggest things that I can recommend. I'd also recommend, in terms of reaching out to investors, definitely try to go for some of the more experienced CPG investors, just because although Rhino, I think we're kind of an exception, and when it comes to actually looking at CPG brands, most tech investors, they have a hard time underwriting to CPG brands. So going after either angels or funds that have CPG experiences, I would recommend probably a good idea. Sorry, that was a very long answer, but hopefully that that was helpful.
No, thank you so much. It was.
Cool.
Awesome. Thank you, Paige. Anybody else cues in the chat? Are we going to be able to get that deck from you, Nicholas, at some point?
Yep.
Awesome. I see Aaron had a couple questions there. Aaron, do you want to hop off mute and ask them?
Yeah, I just like typed them out because I find sometimes that helps me when people type out questions. But the first one, it's just what do you typically see as equity splits between co-founders, especially if someone was a solo founder and bringing on someone new? Like, how would you advise them, like what percentage of equity to give?
Yeah, very good question. So that varies quite a lot. It goes from 5% to 20%. I think it all comes down to you as a founder. If you bring on another co-founder, kind of appreciating what value they'll bring to the table, and trying to, as tough as this is, trying to assign some sort of value to that going forward. But to be more specific in terms of answers, I think we see anywhere from early stages, anywhere from 15% to 20%. And I do think it is important that co-founders, if they have the title of co-founder, has a significant chunk of equity early on, because if you decide to go down the venture route, then obviously dilution will happen, and venture funds are very, we pay a lot of attention to founders' equity stakes, and that I think comes to the second question actually. So a big red flag for cap tables is if we see at the seed stage that founders have less than 15% ownership in the business. The problem for us becomes, what will keep the founders incentivized to run this business if in 2-3 years they only own 10% of the business, right? So I think that's the first red flag. We want to ideally see ownership of ideally 30% plus for founders. That's the first red flag. Other red flags, it's quite a contested and kind of interesting topic, but advisor kind of equity. So again, this comes down to kind of you as a founder and your intuition, but if we see an advisor that has gotten a significant chunk of equity in the business without necessarily buying in, so just kind of getting it for advice, that can also be a bit of a flag. Ideally, we want to see equity being kind of distributed either because someone has bought it or has earned it through tangible work. So I think that's the second biggest flag. And then lastly, at the early stages, if we see a fund that owns more than 30, maybe not 30, 40% of the business at the early stages, I think that's another flag. The big question, of course, in our minds is, again, why did the founder decide to sell off so much to a venture fund so early on, and what happens to their ownership going forward? Hopefully that answered your questions, Aaron.
Yeah, that's perfect. Thank you.
Awesome. Thanks, Aaron. Vivian, I think you had a question next.
Hi, Nicholas. My name is Vivian. I'm the founder of May, which stands for Making Auto Easy. I'm building a car shopping experience built for women by women. We help people understand their options so they can pick the right car for them. So actually, I have, I guess, now two questions because I have a follow-up to Aaron's. So do you have any advice on whether one founder should have more than 50%? Should it be evenly split, or is there a preference from the VC perspective on one having 55 or 60?
Good question. I don't think so, especially not at the early stages. Of course, what we will look at is if you have kind of the 55 and someone else has the 45, we expect whoever has more equity to be kind of the leader of the organization. So let's call it the CEO, right? That's a pretty common expectation. So just bear that in mind when you kind of distribute equity.
Okay, thanks. So my question is about founder updates. When you're talking to startup founders and they're trying to build that relationship with you, do you read all of the updates that you get? And what in those updates do you like reading, or do you skip over perhaps?
Yeah, that's a very good question. So that is a very good way of maintaining relationships with investors, kind of, again, going back to that, investing in lines and not dots. So that's a great way to do it. To put it this way, the best updates I think I see are the ones that are the most concise. So where it goes right into kind of what's gone well, what's not gone well, and where can you help? Because a lot of investors are looking to help. So keeping it nice and short and concise, and kind of maybe 3 bullets on each of those topics. I think those are kind of that works really well for updates.
Thank you.
Awesome. Thanks, Vivian. Ethan, we're going to hop off and you can ask a question next.
Hi, Nicholas. I'm Ethan, co-founder of Expressme. We're helping equip the next generation with articulation skills for the workforce. My question is, going back to the emotional hooks, could you elaborate a little more on that? And I guess maybe give some examples of what were some really great hooks that you've seen in the past?
Yep, for sure. Happy to. See if I can pull up the deck again, because I think that helps a bit here. 2 seconds. So the emotional cues, here we are. Seconds. Can you see my screen again? Not yet. Yep. Perfect. All right. So again, it varies a bit about with kind of what story you want to tell investors or whoever's reading it. But I think the 3 I have here on the slide. So the market is like obviously large. The team is excellent, and the business is kind of at a point where we're ready to take on capital. Those are depends on, like, you can word them differently, but getting those points across the entire deck is really important. So I'd say probably these 3 are the the key ones that we've seen. Another one that's actually a bit underrated and that Rhino used in the raising our third fund is part of investing in a business or a fund is investors, whether you're a venture fund or an angel investor, they are investing in a business because it is more exciting than just putting your money into an ETF, right? And I think a cue we used throughout the deck for our third fund was this will be fun. So you want the investor to not only think, oh, this will obviously make them money, but this being a fun kind of exciting experience for them as well is I think one of the underrated emotional cues that we're fans of internally ourselves.
Okay, yeah, thank you so much.
For sure.
Thanks, Ethan. Jan, I think got a question.
Right. Hi, my name is Jan, and I'm the founder of TutorFlix. It's an educational platform, and I was wondering, considering that you have relationships with Thinkific as a company, I wonder, what do you think are the key challenges that a company or in that sector of activity that they've faced in scaling the company, or and how do you recommend to like face these challenges?
It's a good question. So I think Thinkific operates in kind of the intersection of ed tech and kind of the what you'd call creator economy. So I just want to clarify if you're interested in kind of one or the other.
It's actually both. So
both, okay. Nice, cool. I have to be a bit careful with what I say, obviously. It is a publicly listed company now. But going back to the origin story of Thinkific, the kind of things that they came up on when they were early on in terms of kind of scaling, I think really the biggest one was the go-to-market motion. So scaling their go-to-market motion was an interesting one. What you have to consider is at the time that they were building back in 2012, this was a brand new market. There was not 1,000 providers of LMS solutions out there. So for them, the biggest thing was communicating their value proposition to end customers in a way that made sense, because you have to consider this was pretty much a new solution for these entrepreneurs that wanted to build courses, and they hadn't necessarily seen something like this. So they spent a lot of time refining their pitch to entrepreneurs and so their customers, right? And I think this was one of the big things that once they cracked that, it helped them scale massively, kind of finding that product market fit. So I think that's the big one. The second one kind of early on was pricing. I'm sure as many of you think about quite a lot is how should I price my product? And that was a big one for them. I think at one point they went through kind of that freemium, trying to figure out, should we offer it for free? How do you convert customers? So nailing their pricing versus the value that they provide to their customers was the second big component in them, I think, unlocking that scalability early on. And then lastly is, again, as cliche as it sounds, the team. Finding the right people for the right jobs was something they did very well in the early days, but obviously something that took some time, because you hire people that might not necessarily be a fit, and then as a leader you have to be kind of the ones to say, okay, this is not working out, let's find someone else that might fit the role better, right? So I think those were really the three big things that unlocked their scalability.
thank you very much. The last question I would have is just how would you recommend like facing these challenges? I know it's kind of case by case and it's more of a general question.
Mm-hmm.
But, considering that maybe they had a hard time, finding the right people. Like from your perspective, what were the key ingredients in actually finding the right people or establishing like the product market fit? I know it's back and forth with the users, but usually they have like more specific strategies. I know maybe
That's a good question. I think there are a lot of things that contributed to that. Obviously, product market fit, it is like you said, it is going back and forth and back and forth and iterating over and over and over again, right? And as probably as not helpful as this is, I think it was their ability to be agile on that iteration and not give into that kind of sunk cost fallacy where you say, oh, I've invested so much and so much in this specific product and the direction of this product. So now it needs to be this product. I think their ability to go back and say, okay, this is not working, and their ability to do that quickly led to them being able to eventually find that product market fit. In terms of finding the right people, I think that's a tougher question. Specific tactics I think they used was finding kind of referrals. And as obvious as that sounds, I think that's probably the best way to go about finding the right people for the right job, because as you probably experienced, finding people on LinkedIn or posting kind of jobs on Indeed is kind of tough and might not get you the right people. So again, using your network, whether it's your peers or LOI or investors, I think it's the right way to go about that.
Awesome. Thank you,
perfect.
Jan.
Thank you very much.
I see Shamima's got her hand up here. So Shamima, if you want to ask your question, go for it.
Yeah, thank you so much. Hi, so my name is Shamima. The venture that I am in LOI for is actually IBS. So what I do is I help students get into high-paying jobs, and then I help them land graduate degrees as well. So that's the venture that I'm here for, but I'm like a two-time founder, I would say. There's a second business that I have, and that's what I'm hoping to ask about. So basically, the product that we are building is we are trying to have a delivery service for beauty supply stores, because we realize beauty supply stores do not have delivery services. Like there's a beauty supply store down my street, and the lady is just one person, and she makes at most 3 deliveries a day with her own van. Like she doesn't have a delivery service. So it's like something we've been thinking about for a while. And me and my co-founders kind of split at this very initial stage what we want each person to have. But I was just thinking, in your opinion, it's like, and in our split, we were like, okay, this is what we are taking, and we are leaving this percentage for like any investor that would be interested. Does that ever happen? Like, do people ever actually say, okay, we want this portion or this percentage to go to investors? Like, I came up with the idea, but I want to know, like, is it grounded in, like, is it sensible, basically?
Yeah, the concept is there. I think what most people do kind of usually is they split it between themselves. So all the equity between themselves is say 50-50. And then once they go out to raise, then they say, okay, we're selling X amount of our business. So in effect, you're doing the same thing, but
yeah,
when you do that, of course, you're diluting your own position, and then you're selling a certain amount of the business, right? But the idea is pretty much the same.
Okay. So it's pretty normal to like even initially be like, this is the percentage we would be comfortable giving out.
Yeah.
Okay.
Yeah. And then you put a price on that, and then you get kind of your valuation pretty much, right?
Okay. Thank you so much.
Of course.
Amazing. Thank you, Shamima. There's a couple follow-up questions here. If anybody has any like first-time questions, go for it, throw them in the chat. But in the meantime, Vivian, if you want to ask another question, go for it.
Yeah, I have a follow-up question about co-founders. So if you don't have a technical co-founder, but you have a technical team, is that still okay, or is that looked down upon?
No, that's okay. Ideally, as you scale, of course, either you bring in someone that can lead that technical team, because you'll find and you probably already find that as a founder, your time and effort and resources get split very quickly, and you need to kind of keep focusing on one or two things in the business. And then it's nice to have someone that can oversee kind of the product team and development team. But early on, that's totally fine.
Got it. Thanks.
Thank you, Vivian. Yeah, he's got another question.
So in my case, I'm very lucky to have many tech people in my team, and I've been able to convince them that if we would build an MVP, we would easily get investors. But very early, I know that a lot of entrepreneurs make mistakes when it comes to, and having well-settled contracts. And I wonder what would be your wisdom nuggets concerning that aspects of things, and how do you negotiate these things? How would you recommend entrepreneurs to negotiate these things? Some people recommend vested actions and stuff like that, but I would love to see what you think about this.
Yeah, good question. So just to clarify, you're specifically asking about kind of on the equity front and incentivizing the team with options.
Yes, because I'm not paying anyone, so everybody's working for free on like building the MVP. So
yeah, no, I think you have the right approach. Kind of options and then putting some sort of vesting in there is important. And then as a founder, you're right, it's your job to prove that that at some point that will convert into something more than just options, right? But I think that approach is pretty standard practice and with most early stage companies.
excellent. And do you have like people you would have recommended to be there? Like, we know it could be lawyers at the beginning, but maybe are there other people that could be resourceful in that early stage?
Right. And is this from kind of a broader perspective in terms of guidance on options and equity, or just
Yes,
more advisory?
just options, equity, wealthable contracts, seeing the future, the long term of the company itself.
Yeah. Lawyers would be a good one. The downside, of course, is that they don't do anything for free. Exactly. Advisors, I would say, try to get them involved as much as you now can, especially if they're entrepreneurs themselves, and they will have been in the trenches and will be able to give you some good advice. Even existing entrepreneurs, this is what I like recommending, is kind of doing the LinkedIn scrape of either entrepreneurs that are operating in your space and maybe are past that kind of Series A, Series B level where they're looking to help younger entrepreneurs, reaching out and then asking them just for a coffee chat or something, say, hey, love what you're building, would love to connect and learn a bit more about how you did X, Y, and Z. And then the great thing about that is that eventually, if you build that relationship good enough and you build the trust and they see the value in your business, you can probably convert them to an angel investor at some point.
Thank you, Jan.
Thank you.
Clint, I see Clint got his hand up here.
Hey, Nicholas, great presentation. Thank you so much. My name is Clint, and my venture is called Torpedo. We help students basically land different types of opportunities, mostly in the high school and right now looking into the undergrad level. And my question is that I'm really curious, when you guys look at different types of pitch decks from entrepreneurs, founders, how important are advisors or board members when you do look at them?
Yeah, that's a very good question. So I think different funds will have different opinions. I think at the early stages, advisors and board members are important and they do add value. However, what I will say is that a lot of founders lean maybe a bit too much on and spend too much time in their deck on advisors and board members. Because we know from experience and even with our own founders, right, is that advisors, they are advisors at the end of the day and they'll give you input, but they're not necessarily in the day-to-day operations of the business. So long story short, they are valuable, and they do add value to kind of reducing the risk of a venture in a venture capitalist's mind. But I wouldn't spend too much time on kind of going through each of the advisors' backgrounds and stuff in presentations.
Wonderful. Thank you.
Thanks, Clint. I think we might have time to squeak in one more question if anything's coming to mind. We can throw a Q in the chat, come off mute, throw your hand up. Give it a few seconds here.
Nicholas, I was just gonna ask you about just the current state of VC. Do you feel like it's changed a lot? Like the traction that's needed is being pushed up a lot right now, or have you not felt that at Rhino?
Yeah, great question. I was waiting for that. It is so it's. I mean, joining in 2020 has been quite a ride for myself personally. Obviously, 2020 was kind of when the curve started to kind of just go up and up and up, and everyone was excited about venture and deals were getting done in days, right? Now it is definitely a different environment. Kind of, if I could give you everyone on the call a bit of advice in terms of what's at the front of our minds right now in terms of looking at businesses. You probably have heard this from various sources, but number one is being able to actually build a sustainable, economically viable business does matter now. It's not growth at all costs anymore. Most venture capitalists have learned the value of EBITDA and margins. So that's the first point. Kind of, we look at efficiency and your ability to put capital and resources to good use is measured and kind of looked at right now. The second thing is that investments are not being kind of done in days anymore. Diligence will be more kind of in depth from a lot of funds and a lot of the investors you speak to, maybe even angel investors as well. That's the second thing. So just be mentally prepared that funds might even take a month or two to actually reach a decision. And then the second thing is, although I said at the beginning of this presentation that you should reach out to kind of a lot of investors early on, I think that still counts, but I would spend more time now figuring out what investors you want to talk to and why, and then spending time on crafting a more kind of personalized outreach to them and putting way more time into maintaining that relationship with those specific investors. Just because speaking to kind of generalist investors is tough, and I would definitely recommend kind of just investing a bit more time on building those relationships with investors you like specifically.
Thank you. Yeah, that makes a lot of sense. Appreciate it.
Sure.
Thank you, Braden. And the timing is absolutely electric. So thank you, Nicholas, for spending the afternoon, morning, wherever you may be calling in from with us. This has been really fantastic. Can't thank you enough. And everybody, as you're hopping off, going into your weekend, make sure to hop off mute, show some love to Nicholas and to each other, and take care of yourselves.
Thank you.
Thank you so
Yes.
much.
Thank you. See
Yeah,
you everyone.
Thank you. Thank you. Bye.
All right, take care, everyone. Take care. Nick.